All right. Most entrepreneurs start their business and they run their finances by the checkbook, right? Which I'm sure you can guess what that means if you haven't experienced it yourself. You look at your checkbook, you say, or you look at your checking account, you say, oh, I've got money, I must be good. But as we all know, that doesn't scale, right? That doesn't work. And it can lead you to feeling out of control. And control is what you're seeking then at that point. And that's why a lot of entrepreneurs end up adopting a budget. A budget is a great tool for control, for feeling like you've got a handle on things. Now, the problem with a budget is that it doesn't scale as your business grows. And I want to show you what I mean by that. Let me give you a demonstration of that. So when you have two people in your business, how many relationships do you have? Well, two. Well, from me to you and you to me. So we've got two relationships. Now we add a third person. How many relationships do we have? Give you a second to think about that. All right, we have 6 relationships now, right? Look at all the arrows where we're going. Now you add a fourth person. Now how many relationships do you have? 24. Look how fast this grows. And if I had more room on the slide, I'd show you the next one. You add a fifth person, it's 120. It gets real crazy real fast. And you've all experienced this in your own business if you've gotten to that size, right? And you can see how complicated it is. And so control is not going to work, right? It does not work over time. So the other problem with a budget is that it ends up being a license to spend. So lots of times a department manager will say, oh, I've got money left in my budget at the end of the year. And in fact, large corporations or government, they deal with money that way. If you don't spend your money in one year's budget, you're not going to get that money for the next year. That's a foolish way to run a business. You don't want people overspending just because we put it in the budget. We also don't want people underspending. There are times when you are growing faster than you thought and you need to accelerate hiring. You need to accelerate purchases of equipment, or you need to rent a new building. You need to move faster than you thought. And if you stick to your budget, you're not going to be able to keep up. You're going to burn your people out and you're going to burn your machines out. So that's why we're shifting focus here from a budget idea into forecasting. So welcome everybody to Financial Forecasting and Planning. I'm Ted Sarvata. My co-host is David Chavez, CEO of our firm, Assured Strategy. We're not going to talk about us today. You will see our expertise from what we present to you. We'll get to know you later if that's in the cards. We don't want to waste time talking about us. We want to talk about the topic and talk about you. Right? So our business is based in scaling up, in the 4 decisions of scaling up: people, strategy, execution, and cash. And today sounds like cash, but I'll tell you something else in just a minute. We're going to talk about what else it's about. All right, so where does scaling up come from? Vern Harnish wrote the book Mastering the Rockefeller Habits first, and then he wrote the book Scaling Up. So the word scaling up, right, that's where it comes from. We know about startups, and we're focused on scale-ups, those middle market companies. And then Vern's newest book, Mastering the Rockefeller Habits, 20th anniversary edition, really realized that there was a lot of gold in the first edition of Mastering the Rockefeller Habits, and he's brought it back. And that's a great book for people that don't want to get into all the nitty-gritty of scaling up. Scaling up is a textbook. You really want to dive into each of the individual pieces when you're ready for them. But to sit down and read it, you probably just want to read Mastering the Rockefeller Habits. And I recommend the 20th anniversary edition. All right. So as I said, we think about cash when we think about financial forecasting. It's right there. Finance and cash, they sound the same. But I want to start with strategy, because financial forecasting has to start with your strategy. Now, when we talk about what is scaling up, I want to show you the number one tool of scaling up. This is the one-page strategic plan. People talk about getting everybody in their business on the same page, metaphorically. Well, this is the actual page. It's not a metaphor. It's an actual page. And this goes all the way from the gray boxes, which is your core, meaning core values, core purpose, and core competencies. We're not going to get into details on all these boxes today. This is obviously a lot going on here. It can take people a year or 2 years to really get this dialed in, but we can use this right away, even starting today. So then moving from core from the gray section into the blue section, which is strategic thinking. And I want to point out, people talk about doing strategic planning. That doesn't exist. Those are 2 different things. We're doing strategic thinking, and then we're planning our execution. And that's what the yellow part is for. is execution plan, the yellow or the orange part of the one-page strategic plan. And if you don't have this document, we're happy to send it to you. Just get in touch with us and we'll send it to you after the webinar. All right. So I want to get into some of the details and use the one-page strategic plan to show what we need to be thinking about as we're beginning to think about financial forecasting. All right. We're going to focus in on column 3, the targets at the top of column 3. This is our 3-year column. You pick a date out there in the future, December 31st, 2027, for example. Otherwise, it's too vague. I don't know if this has happened in your business at all, but people say, oh, 2 or 3 years from now, I have a 3 to 5 year plan. What is that? Pick a date, make it concrete. So if you think about 3 years from now, then you choose your revenue. What is our revenue going to be 3 years from now? Most of our clients, it's about double where they are today. No matter what day they pick, 3 years from now, they're roughly going to double, right? It might be a little bit different in your industry or with your business model. It varies. So you have to choose what date, what revenue, and then you want to choose where you're going to be in terms of profitability. If you're not generating profit, what are you in business for, right? Profit will fund your future growth, and it funds the accomplishment of your purpose, right? You're moving towards your purpose. You can't do that if you're not profitable. You can have a big heart. You can want to serve people and help people. That's great. But if you're not profitable, you're not going to help very many people. So keep that in mind. And then you want to think about either market cap if you're a public company, or more likely for mid-market companies, you're thinking about cash. But most of our companies are thinking about cash. Some of them are public and they're thinking about market cap, but you got to think about cash.
Hey, Ted, I wanted to insert here. I do a weekly radio show, and you can get on our website and you can find those radio shows. But I did one last Monday with a guy who actually, Young Ho is his name, and he's out of Northern Virginia. They got so focused on their culture and building their culture, they forgot to pay attention to profit, and he got himself in quite a bit of trouble. So I love how you said that. And I think it's really important for everyone to think about that in the sense of you have to have profit no matter how good your culture is. If you don't have profit, you can't live that culture. So if you're a person who loves culture and wants your culture to be great, well, make sure you have profit too, because you want those two things actually make it all work.
And if you want to learn more about culture and dig in on that, we have other webinars and other services that we're happy to dig in on that. It is absolutely essential. Culture is essential too. If you're only focused on profit, you're not going to make it very far, right? Profit is a result. It's not the reason. It's not the reason for things. You have to have profit, but it will not drive your business if that's only what you're focused on. All right, from there, from our 3-year targets, now we have to think about, well, what are we actually going to do in the 3 years? And that's where our key thrust and capabilities come in. And from there, we're focused then on execution, right? From our 3-year strategy, then we're moving over into the 1-year column, and we're thinking about what are our goals for 1 year. And so we're breaking this plan down. The idea is you've got a 3-year plan, and then you're zooming in and you're saying, what's the bite of the apple, right? If the apple is our 3 years, then where am I going to be in 1 year? And these are guesses. We don't know. We can't see the future. You can see a lot more clearly what's going to happen 1 year from now than you can 3 years from now. But if you're not focused past the end of 1 year, you're going to be adrift. You don't know longer term where you're headed. So you need financial targets for 3 years. You need goals for 1 year where they're broken down. And you notice there's a bunch more categories here. We can get into gross margin and inventory days and accounts receivable days. These are customized for each company. You choose what are the most relevant execution metrics for you. Most businesses, they're in one of two camps. They either have way too many metrics or not enough. They have too many, they have like 100, and they have like 5, 6, 12 in each department. And the executive team doesn't have any clue what's going on the big picture, or they are not measuring anything at all. That's more rare. Most entrepreneurs, they're measuring something, and they're usually measuring a lot of things, and they don't know what's relevant. So we need to hone in on what should your executive team be focused on a weekly or perhaps monthly basis, but weekly is best in this 1 year column.
Yeah, so like if you have those 12 KPIs, like you said, Ted, they want to probably pick 3 of them that really have a lot of relevance to the strategic plan overall and focus in on those 3 for that functional area.
Yep, very good. And then from there, we're going to expand into, okay, now we're in the 1 year. What are we going to do? there are actions that we're going to take, and we call those key initiatives. Those are your annual priorities. So again, you have 3-year priorities, and then you break them down into annual. Now, from there, we're done with the annual column. Now we're going to move over into the quarterly column, and we're going to see, well, what are our numbers for this quarter? And again, you can adjust these numbers every quarter. That's the beauty of forecasting, and the beauty of you don't have to know everything. Heading into Q1, you're going to have the annual numbers and you're going to have the quarterly numbers, but you don't really know necessarily what's going to happen in Q2 yet. But based on what happens in Q1, then you can adjust for Q2 and Q3 to keep you on your annual plan. And the same thing with our actions. We call those rocks in the quarter. What are we going to do this quarter in order to accomplish our annual priorities, which is going to accomplish our 3-year strategic thrusts? All right. I'm going to hand it over to you now, David.
Okay, great. All right, so I want to start off with when we're just to give you a little my background. I've been a CPA for over 30 years now, and a licensed CPA for over 30 years. I owned a CPA firm, and I would share with you that I would tell you people probably go more to budgets than they do forecasting, and I still see that today. Even though we know all we know about budgets and how they're misused a lot of time. Ted covered some really important things right at the beginning. He really emphasized that a budget often is a license to spend when our revenue may not be hitting those targets in the budget, but all the expenses are still being spent in the budget. And then we get ourselves into a cash situation. So forecasting starts to reduce that problem, and especially if you're updating your forecast every single month. And then what we like to do is run them out 36 months, because we have the way the strategic plan is laid out for scaling up is the 3-year column, the 1-year column, then the quarterly column, like Ted just showed you. And we want to get 3 years out so we can determine what our revenue is going to be, what our profit's going to be, and how much cash we're going to end up with. So the first thing I want to do when I start to budget or start to forecast, and now I'm saying the wrong thing, but when I start to forecast, I want to pay attention to the economic conditions. I think far too many business owners and senior leaders inside of companies don't pay enough attention to economic conditions that are affecting them. And I'll talk about that a little bit more as we're going along. But then the next thing I want to do is I want to identify the strategy of the company, because whatever our strategy is and our execution plan is going to determine what our costs are going to be. Individuals like, and maybe we could mute this person. Maybe not. All right, thank you. Then identify, so we want to identify the company strategy, and then we want to move into assessing the financial statement quality. So what I mean by this, and I know we have a lot of CFOs, a lot of controllers on this call right now. There's about 100 people all together. There's business owners. There's people in different levels inside of the company. But I have to step back and look at my financial statement quality. I see a lot of times people get promoted to CFO position when they really have no finance background, so they don't really understand finance. They may understand the accounting, but they don't understand finance. And this is a common thing that business owners do. They promote somebody who doesn't understand this, so they don't really know how to do some of these things. But assessing the financial quality is, do I have good information historically that can help me leverage into the future? If I don't have good historical information, my ability to predict the future may be inhibited a little bit by my lack of good information. Okay, so next, Ed. So the next one is to analyze profitability and risk. So we have created a strategy that and then we created the execution plan to go with the strategy. Now I need to look at my plan and I need to see how much risk I have. One of the things that I talk often to business leaders about is squirrel chasing, and especially entrepreneurs. I am an entrepreneur by trade. Even though I'm a CPA, I've started, grown, and sold 5 companies. And I would tell you that I love to chase squirrels. My team here heard me talk about this before, that I'm a professional squirrel chaser. Well, squirrel chasing actually will eat up cash alive. I mean, it'll suck cash out of your business in a really good way. So I want to step back and I want to see how many squirrels I can actually chase at a time. Because when I'm chasing too many squirrels, I'm spreading out the resources of the company, and I may be spreading it out and creating risk for myself. So I want to sit back and I want to analyze my financial statements, and I want to ask myself questions about risk and profitability if I'm going to use this execution plan to realize my strategy. All right. And then the next thing I want to do is I want to forecast financial statements. So once I've done all these steps, then I want to actually do the forecast. So I'm not going to show you how to do forecasting. There is no way we can do that in 1 hour. But I'm going to explain to you how to go about doing it. And then if you would like us to help you with forecasting, we will make that offer to you for free at the end. Okay. But forecasting and financial statements comes next, where I'm actually putting it out 36 months out into the future. And I'm assessing what I'm trying to do back to my plan. So the plan Ted talked about at the beginning, I'm actually taking that plan and determining what I need for the next 36 months. And I'll get into that in a lot more detail. Then you want to value your company. Why do we do forecast? Why do we have good historical information? So we can determine where the value of our company is at. Because if we don't know the value of our company, most likely we're going to think we're going to sell it, and we may not be able to sell it. And I'll give some examples as I'm going along, but let me just give you one. About a few weeks ago, I'm with a client and I ran their valuation for them real quick. And when we ran their valuation, I asked them what they thought the value was. They told me $8 million. We got all kinds of financial information together. We spent a little bit of time putting this together. It was 18 million. They had no idea it was that high. And so most of the time what we'll do is get people to guess really high, and then it'll come in a little lower. But this CEO actually guessed lower, and it was a lot higher, more than 2 times more than what they guessed. So investment and decision-making models. So why do we do forecast? Because we want to look at the value of our company, and we want to make sure that our value stays in line. If we're not paying attention to the value, we can't influence the value when it's time to sell, or when I check out of the company, be it by some act of God, or I decide to end the company. The credit worthiness, I can check my credit worthiness through projections and determine whether I have the ability to borrow money for future endeavors, like my future squirrel chasing, if you will. And then I need to manage revenue, profit, and cash. So forecast actually allow you to do the same thing a budget does, but they're forward looking, and we're constantly updating them due to the conditions that are going on. And I'll talk about that several more times. And then we can also create forecasts and run models through them. Like, hey, if we did these 3 squirrels, what would that do to our financial statements? If we don't end up profitable, we could say, hey, maybe we have to cut one of the squirrels out that we want to chase. And so that would help us evaluate those ideas to see if they're going to add profit to me or they're going to take profit away. Because many times I think a lot of us that are entrepreneurs on this call would actually say that we've all made the mistake of chasing that squirrel that cost us more than we ended up getting for it, that squirrel. So I know Warren's on this with us. He's one of our coaches. He's an entrepreneur, former entrepreneur. I am. We both have made this thing. We actually talk about it it. And it's funny now, but it wasn't funny at the time, right? So next, Ed. All right, so considerations when you're getting ready to do forecast. I want to have realistic decisions, and I have to remember that garbage in is garbage out. And that goes with your financial statements too. If the data collecting to put information into my financial statements is not good, my financial statements probably are not that great. And if I don't have good financial statements, I have no way of keeping score. You know, Ted and I are both soccer fans. Ted is a huge soccer fan. Actually, he's far more a bigger soccer fan than I am, but I'm a soccer fan also. Could you imagine watching a game and not knowing the score? I mean but that's how you want to think of that. So if I don't have good information coming into my accounting system, then I don't have good information coming out. Which if I don't have good information coming out, when I start to do projections, I may run into some problem. And then I want to talk about optimism and conservatism, right? I want to be optimistic, and I want to be also conservative in my forecast. What I like to do is run 3 different versions of forecast. Hey, this is what we think we're going to do. Here's the optimistic view of what we're going to do. And then here's the floor of what we're going to do. And when we're hitting the floor, maybe we have to start cutting things because we didn't realize some of the things we thought we would realize. Precision. We want to make sure that we have accurate information. I just talked about that and rolled it into some of the other ones. And then once we do it, we have to do the sniff test. And you wonder what the sniff test is. Like when I owned my CPA firm, we would just back into the numbers on our hourly rates. We would take our hourly rates. We would take the number of hours that people have available to work. And we would see if we had a right amount of people that could even meet that revenue projection. And I'll talk about that a little bit more, but you want to sort of do sniff test on your ideas of what you think you're going to do. Because what I see a lot of people do is like, I'm growing, I'm just going to grow 20%. Well, where did 20% come from? And I'll talk about that a lot when we get into the next few slides. Then I have internal consistency with financial statements and as well as forecasting. Even if you do it a little bit wrong, if it's consistently done, it'll probably give us pretty good information, even if it's a little wrong. The problem is that a lot of people, what they'll do is they'll switch what they're doing year after year, and they forgot what they did last year, and now the consistency is not there. So just try to be consistent as possible when you're doing these financial projections. And then assumptions. What assumptions am I making about the future? And then I want to understand which numbers are the assumed numbers so that I can monitor those quite a bit, because I want to make sure I'm realizing what I projected. Next slide, Ted. All right, so the 7 steps that we're going to go through the 7 steps of building a financial projection. The first step is sales and operating activities. Then I'm going to go to operating expenses, assets and liabilities that I may incur in this model that I'm building right now. Debt and capital structures. Do I need debt? Do I need to go raise capital? One-time gains and losses, if any, so things like extraordinary items or items that only happen one time, like I sell a building and it comes on to me and I get the cash for that. That's a one-time item. Then cash in my balance sheet, and then the cash flow statement, which I'll get into all of these as I'm going through. But I wanted to show you a few of the financial statements first before I go forward anymore. And these are very basic financial statements. I didn't want to, I could have put millions on here. I could have put trillions on here. It didn't really matter. The numbers aren't important. I wanted to keep it relatively simple so I could understand. This is the income statement. This is when people forecast, this is the thing that they're going to use quite a bit. When you're using the income statement, it's good to use the income statement as your forecast, but I also need to forecast the balance sheet, because if I don't forecast the balance sheet in addition to the income statement, I may have things a bit out. I may not have all the costs that I may incur inside of my income statement. And I'll show you that in just a minute. Now, when we talk about financial statements, we don't talk about the financial statement. It's the income statement. I see a lot of businesses out there where when I ask them for a financial statement, they'll send over their income statement. When we say financial statements in accounting, it implies three different statements: the income statement, the balance sheet, and then the cash flow statement. It's all three of these statements. And I think a lot of accountants out there, they miss the cash flow statement, because I'll even ask a controller sometimes, and they'll give me the income statement, balance sheet, and I ask them where the cash flow statement is, and we don't do that here. Well, I don't know why you're not doing a cash flow statement, because I want to know where my cash is at. Because Vern Harnish from who wrote Scaling Up, he has this great quote. It's called "Revenue is vanity, profit is sanity, and cash flow is king of all of those things." So if I don't know where my cash is at, I could get myself in real trouble really quickly. And profit is not cash. And I'll explain that to you in just a second. So let me show you the interrelationships of these statements. This is why you have to do all three. I have a beginning balance sheet. Then I have an ending balance sheet on the other side. So the beginning of the year, I have a balance sheet, and at the end of the year, in between that is my income statement and my cash flow statement. So if I'm not doing all three of these, I may not be projecting correctly what my results will be. So go ahead, Ted. And I'll come back to this interrelationship in just a moment. So when you're doing step one, revenue by market, price, and volume. So I gave the example, when I'm doing revenue, I'm just going to increase everything by 20%. Well, where do you get that number from? Like right now, the economy is slowed down a little bit. The government's been working very aggressively to slow it down a little bit so they can stop inflation. And if I don't take those things into consideration, I don't know if I'm going to grow by 20% or not. So I have to be real careful when I just use 20%. I want to look at market conditions like I was talking about earlier. I want to look at the economy. I want to look at what's going on. I want to understand the economics of the world. And then I want to understand my price and my, okay. Let's mute this persistent. Sorry about that. I want to also look at my price and my volume. So my price and my volume dictate what my revenue is going to be. And so I want to consider all these things. Like if I'm offering different services, what type of services am I offering? How many offerings can I do a year? My sniff test, right? If I had 800 of them and I only have the capacity or people to do 400, my 800 is way off unless I'm going to double the size of my people. And then when you ask people these questions, often saying, hey, are you doubling the size of your people so you can deliver all these? They'll say no. And I said, well, there's really no way to get to this revenue then. So you want to look at the life cycle, technology, how you're using it, technology that's coming on board so that you could utilize it and take advantage of efficiency. And then I want to look at my business model, which the business model is made up of a whole bunch of processes. And people often think that they're going to increase cash flow by collecting the money. More cash is in processes than anything else. And we're going to do some other workshops on webinars on business models, on cash, excuse me. And we'll talk about those different types of things that processes do create a lot of money. Inefficiencies of processes eat up more cash flow than I've ever seen. I've been in over about 1,000 businesses, physically been in them in my career. And I will tell you, I see this so often, it's scary. So I want to also look at economic conditions, and then I want to look at my segments that I'm in, like the different types of businesses or offerings that I have. And I want to make sure all of them are healthy, not just a few of them or not just the main one. I want to look at all of them and make sure that they're all healthy. So my first step is to look at my market, think about my pricing, think about the volume I can add, looking at it in the life cycle. Where am I at in the life cycle of my business? Am I a dying dog? Am I rising? Or what am I doing? My business model, technology, and all these different things. So let's go to the next step. Step two, after I build up my revenue model of how I'm going to determine my revenue, and I should have a lot of detail in that revenue model. Now I'm going to look at my operation expense. And what I need to think about is what are fixed costs and what are variable costs. And if you don't know the difference of these, because I know there's people in all different levels in this webinar, variable costs are costs that I incur when I receive revenue. So for us at Assured Strategy, when we provide the service to a customer and then we have to pay a coach to do that, my variable cost is that coach that's doing that revenue generation, right? And if I have a product I'm selling, like let's say I'm selling iPhones, okay, my variable cost is the cost of this iPhone to me, because I don't pay for a phone until I actually sell it. Usually that's when the cost actually is incurred. Fixed cost, on the other hand, are things that are fixed for a longer period of time, okay? And again, rent would be a good example of that. Automobile expense would be a good example of that in certain ranges. But fixed costs have to do with costs that I incur no matter if I sell one phone or 20 phones. I still have these costs, okay? Then I want to look at my cost of sales and my cost of goods sold. Cost of goods sold for products, cost of sales for service types of companies. And then I want to look at my sales, general and administrative expenses. And I want to look at my revenue. I want to understand what it's going to take to generate that revenue and make sure my costs down below all match up. So let me give you an example of this, and especially the fixed versus variable. Let's say my office is maxed out already. I don't have any more room, okay? And that's a fixed cost for me. But this year, because I'm out of room, if I had 10 more people, I'm going to have to increase the size of my office. So my fixed costs are going to go up. So I need to take that into consideration. And oftentimes these fixed costs go up considerably because I'm not just going to rent 1,000 more feet to get 10 more people in. I'm going to probably rent 4,000 more feet so I don't have to rent again for a couple of years, 2 or 3 years. So I'm going to incur that cost now for the future growth that I'm going to have. So I have to understand those when I'm looking at my forecast. Then I want to look at any other cost I may have, and then I want to pay attention to my segments if they have specific cost for the segment that I need to consider. Next slide, Ted. All right, so then the next step is to take and look at what assets I need to realize this plan. So I just gave you a great example of that. If I need to get a new office space or I need to expand my office space, I'm going to incur leasehold improvements. Well, leasehold improvements are not going to go on my income statement. They're going to go on my balance sheet. They become a fixed asset. And then I expense them through depreciation over time. So I'm going to spend the money. I'm going to give cash, but I'm not going to incur any expense on my income statement. So it's really important to understand this, because oftentimes when I owned my CPA firm, we used to get people in our office all the time. Well, what do you mean I owe Uncle Sam $1 million? I don't have any money. And their profit is $3 million, and they didn't think they were going to owe anything, and that just because they didn't have any cash. Well, it doesn't work that way. You're going to pay on the profit of the company, right? So you want to think about the assets and liabilities because they impact. So I want to think about operational assets and any operational liabilities I need. If I'm going to have cash shortfalls, am I going to have to borrow money? How much is that money going to cost me? And then I want to look at my inventory turnover rate. How many times am I turning over the inventory? If I have products, I have to pay attention to this very closely. How many times am I going to turn over my inventory? And one of the examples we give in some of our other cash talks is that if I have if I'm turning inventory 3 times a year and I can turn it 4 times a year, I will increase my cash flow significantly. And so we can explain those things to you, but I just want to cover, think about inventory turnover rate also. How fast can I turn that inventory? Then step 4 is leverage and capital. How am I going to make up for cash shortfalls? So once I do the income statement, and now I'm looking at the balance sheet and I'm trying to look at my cash, I want to make sure that if at any point in that 36 month outlook, I am going to be negative cash, I have to do something. What a lot of people do is they do something at the last minute, and usually it has to do with not paying vendors, things like that, that end up hurting their operational business, right? If I know I'm going to be short cash 6 months from now, and depending on what the cash shortage is, I could either raise debt or get a credit line. I could go out and get a loan, or I could raise capital. So I need to make sure that I'm paying attention and if I see any cash shortfalls. So that's leveraging capital. The next step is to look at my cash and my balance sheet. So now I was on the operational side. Now I'm coming over to the balance sheet. Do I have sufficient cash? And I'm overemphasizing this in this webinar. I have to make sure I have the cash to chase the squirrels that I want to chase. Those of you who weren't on the webinar when I talked about squirrel chasing are initiatives, are new things that I'm trying to accomplish inside of my business, right? And I want to make sure that I have enough cash reserve in case I get myself in trouble, or if something happens in the economy. Let me give you an example of this. In the time of COVID, when COVID started, a lot of our clients, because we preach this cash stuff to our clients and we really help them build cash reserves, most of our clients were sitting on tons of cash even when COVID happened. So what did they do with all this money when the government started giving away all the money? They started buying other companies because other companies didn't save the cash, and now they had to get out of business. And some of my clients were buying companies for pennies on the dollar just because they had the cash reserves. So you always want to keep a cash reserve. I like to keep a cash reserve for 6 months out into the future. So how I do that is take away all the revenue and look at my operating expenses for the next 6 months. And can I meet those expenses with a little bit of variable costs? Most of those are fixed costs, but I'm looking at a little bit of variable costs too. So that's how I do it. I go out 6 months and I want to keep that in reserve. That money becomes just stays there in case something happens weird in the world. Then I want to improve my cash, and then I want to complete the balance sheet. Then I want to go to step number 7, and I want to complete my cash flow statement. And this is derived from the actual and the forecasted, the actual financial information and the forecasted information. We can actually look at cash flow. I do not want to just look at where the historical financial statements. If I do that, it will not tell me what my cash flow really should be. I want to look at past performance and where I'm forecasting, and in particular where I'm forecasting, because most people think that because I have money, I will continue to have money. It's if I have too many initiatives, I may run out of money sometime in there. All right. So operating. So there's 3 sections to the cash flow statement. Where is am I making cash from my operations? Am I making or using cash in investing? And investing is buying assets or paying off short-term debt, if you will, but that's more in the financing section, but it sort of crosses over a little bit. I don't want to get into all those details, a little too complex, but mainly it has to do with buying and selling assets. And then financing has to do with debt and equity. So if you think about it, the operating is my income statement cash flow. The investing is my current my assets on my balance sheet. And then my financing is my long-term debt. And again, I made a mistake when I said investing is my short-term assets. It's my long-term assets, like what the changes of those are. So once I get all these steps done, then I go to the next thing. I want to go back to the balance sheet and income statement. So now I have a forecasted income statement, a forecasted balance sheet, and a forecasted cash flow statement. So let me take you back to these interrelationships that I talked about early on. I showed you this. So look what I'm talking about. So my AR balance at the beginning of the year is 180,000. I have 210,000 in revenue that I sold products, right? I collected only 200 of that. So now I have an AR balance of 190,000. My AR balance went up 10,000, which that means I don't have $10,000 of cash because I lost 10,000 of cash, or it's delayed in this sales of 210 and only collecting cash of 200. And so you could see my cash balance is 50. My change of cash from all these items is 27,000. So my cash is ending at 23,000. 10 of it is down here in the increase of the revenue. So I lost 10,000. And this is what happens with a lot of entrepreneurs, where they get themselves in trouble and they don't understand why they have no cash, why they owe taxes, or why they don't have cash. And it's because my balance sheet and cash flow statement are affecting my outcomes also. It's not just the income statement. So I want to overemphasize that. Now, once I have the financial projection done, I want to get a valuation done. And I want to understand where my value in my company is all the time. So every year I want to really get a valuation done. And we offer these free on our website. If you get on assuredstrategy.com/resources, you'll see the little button there for a free valuation. It's also on our homepage. And when you're thinking about valuation, you want to think about several different things. So the first thing is decisions. All right. What decisions do I need to make for my company? If I don't know the value, I don't really know what decisions I need to make. If I have some objective of selling the company for 50 million, right? What decisions do I need to make to get to that 50 million? The next thing I'm looking for is planning. If I know my valuation and I know where I'm trying to get with my valuation, I can plan to do things that will increase the valuation of my company. And let me say this really quickly about valuation. 80% of the businesses in the United States are never sold. When you talk to business owners, I ask them what their exit strategy is, and they'll tell me that they're going to sell their business. 80% of them are never sold. They just close because people didn't look at what their valuation was, and there's really no value in the company. The more I'm involved in the company as the entrepreneur, the less value it has. Okay? So the more my executive team or my directors and my managers and my supervisors are running the company, the more value I've created for myself. So how do I get out of the day-to-day business and do that? Then I want to also know my valuation, because valuation is going to tell me whether people will lend me money or people will want to invest in my company if I need cash. So I want to pay attention to the evaluation as much as I possibly can. Then the next thing that we want to look at is the M&A opportunities. if I'm going to buy another company or another company's going to buy me or we're going to merge them together, I want to know my valuation so I know how to have those conversations. And there's a couple more: performance and market position. So I want to know what my performance is. If I don't measure something, I may not improve it. If I measure something and know what it is every year, I will consciously work on it. And then I want to understand my market position. A lot of people will tell me, oh, my valuation is 5 times my revenue or 5 times my EBITDA. These are averages. This is for an average company. So if you think you have an average company, then it may be a good thing to use those rule of thumb numbers. But I find most business owners think they have an extraordinary company. And if you don't know if you have an extraordinary company valuation wise, you don't know where you're really going to end up selling your business. So you really want to understand this so you can really maximize the value of your business.
All right. So we want to talk a little bit about some companies that we have worked with that were not using forecasting effectively and what happened to those businesses. All right. So I want to give an example first of a manufacturing client that we have worked with that they were basically, sticking their finger in the wind to know where things were going. And they were looking at their backlog and saying, well, sales is going fine. And so therefore we can expand and we can spend more on personnel. We've had people that we wanted to hire for a long time and we started hiring them. And then one of their biggest customers who represented a massive part of their backlog said, oh, we ordered too much. We're going to need to cut back. We're actually going to need to cancel some of those orders we already placed, and we're not going to order in the future. And the company emotionally was now making another decision. They weren't looking at the fundamentals. They were just emotionally reacting to one of their large customers, and they put a hiring freeze on, and they didn't really know why. They were just reacting. Now, I'm actually happy in that instance that they were not over hiring, right? It's a good idea, but what's it based on? It was based on emotion. It wasn't based on the numbers. What they found after they had the hiring freeze for a couple of months, what they found was the fundamentals actually looked pretty strong, and they had a lot of other customers that they had not effectively gone after because they were relying on that one big one. But they didn't have a forecast to really guide them. So it turned out to be a good story in the end, but they really still need to be using forecasting and projections. So you have an example, David?
Yeah, I do. I have a couple of different clients. The same thing happened to them. These are service businesses, but what they did is they said, "Hey, we're going to increase sales by." Most of the time when this happens, it's like 40% this year, and they build their whole budget off of that, right? And so they're spending money, all ramping up for this 40% increase when 10% materializes. I have costs that are going on at 40% increase in revenue, and I have now gotten 10, and then they start praying. So once this starts happening and they're only hitting 10%, they'll go, we'll get it next month. We'll get it next month. We'll get it next month. And by the time they actually get it, now one of them actually went out of business. We didn't get in there soon enough to help them. And one of them struggled for a couple years afterwards to build their cash back up from that situation. A lot of businesses go out of business from chasing too many squirrels and spreading their cash out too thin, not understanding where their financial forecast needs to be. So I think that it's really important to really understand the importance of forecasting and getting it out there a little ways into the future.
All right, very good. So we have a couple minutes for questions. You can put questions in the chat, or you can actually take yourself off mute and just ask a question if you've got one. We're happy to take any questions at this time. Give you a moment to think through that.
And look like we have any.
Yep, I'll also give our contact information so you can ask questions later. That's totally fine. We have some upcoming events. So Assured Strategy ourselves are a growing firm, and we use these tools as we grow. We have 3 workshops coming up, September 17th, October 15th, and December 10th in Denver, Fort Lauderdale, and San Antonio. And then we also have webinars. We've got 2 in August and 1 in September. and you can see what those are. All of our events are at assuredstrategy.com/events. We try to run 1 or 2 webinars a month, and then several workshops a year. And we'd be happy to host you and your leadership team in person for those workshops, or of course online for webinars just like this one.
Ted, Rachel came in and asked a question. Do we receive the PowerPoint for the reference? Yes, we will. We will send this out to you once we get for the people who actually attended the webinar. Yes, we will send it out to you.
Yep, very good. So here's our contact information. If you have questions after the fact, there's my name and email and phone, and David's as well. So we're happy to receive that. And then for those of you that came today, we have a free offer for you. As David mentioned, we are happy to help you with the brainstorming for your financial forecasting. And what we will do for the first 5 teams that get in touch with us is we're happy to host a 2-hour brainstorming session for you to gather all the information you need and really think about your forecasting. And then once you go produce that forecast, then we're happy to look at that after the fact. We're happy to look at that for you. So all you need to do to take advantage of that is you can email me, tsarvata@assuredstrategy.com, or you can visit our free offers page to take part in any of our free offers.
Yeah, and check out our website, assuredstrategy.com, and the free offers. It's actually under resources, and we have 5 free offers there, but Ted is making this for 5 of you available today. So the first 5 that ask us to help build out their forecast for them, we'll be happy to do that for free.
All right, very good. So we that's all we have for today. We would really love to be able to help you. Please reach out to us. We work with growing firms, and that's why we exist. We exist to guide leaders through change to find their freedom. So if that sounds like you, get in touch with us. We're happy to help you with your forecasting or valuation or any of those other free offers. Thanks everybody for coming.
Thank you everybody for coming. There's so many of you on this webinar. We're really excited that you all joined us because this is very valuable information. Have a great day.
Bye, everybody.